All right, so today I wanted to discuss an area where I see a lot of clients have confusion, and it's how are their businesses taxed. And some people that have S corporations, I see that they don't really understand that the S corporation does not pay tax at the S corp level. They think that they're always asking questions of or they're making incorrect statements that their corporation is paying tax when it's an S corp. And I see that there's a lot of confusion, and I think it's very important for contractors and business owners to really understand the basics of taxation so they can appropriately plan for their expenses throughout the year based off of their taxable income. And when you're a client of the firm, a premium client or a client engaged in tax planning, this is something that we discuss very often and we take a look at, and it's more productive conversation is always had with business owners who understand the basic concepts of taxation. So, who is the taxpayer? The Internal Revenue Code basically, or the way that I like to understand it is, there's really only two forms of taxpayer, right? Or two entities. And for this example, right, for corporations, there's a lot of other nuances for other areas of tax, but this is applicable to 99.9% of the clients on annual tax filing basis. You're going to have an individual that reports a form 1040, right? That's the tax return your accountant sends you every year, where you report your salaries and wages and income received from businesses, or income that's being reported from businesses that you have, partnerships, S corporations. And then you have a C corporation, which files its own tax return and is responsible for its own tax. So an LLC is the most common structure that we see, and the LLC in itself is not a federal tax classification. So for example, here in Florida, let's say you went ahead and you incorporated an LLC and you pulled an EIN, it automatically defaults to a disregarded entity, which you can see over here on the left hand side. Disregarded for federal income tax activity generally reports on the owner's tax return. So when you go to your accountant, he's going to prepare a 1040, and then you're going to see a Schedule C attached to that 1040, which is where you'll find the activity of a disregarded single member LLC. So when you open an LLC, you also have the opportunity to elect how you want to be treated, or if your LLC is opened with multiple members, it automatically classifies as a partnership. We're not going to get into the details of partnership for the sake of this presentation. We will have presentations in the future for partnerships, and for my clients, developers and contractors. A lot of the times we'll be discussing partnerships for developers. But for the purpose of this video, an LLC can elect to be taxed as a C corporation, or it can elect to be taxed as an S corporation. Again, by default, if it's single member, it's going to be taxed as a pass-through entity on your personal tax return. And if it's multi-member, it's going to be taxed as a partnership. And if, none of this is intended to be tax advice, so you should, consult with your current accountant, or if you have any questions, you can call the firm, and we'll be more than happy to answer your questions and help you determine which is your active filing status based on your prior year return. Or if you're looking for a tax planning engagement, we can also determine, what the best path moving forward is. So 3 federal tax systems at a glance. So you have the owner level single member LLC, the pass-through S corporation, entity level C corporation. What does that mean? So the single member essentially goes straight to the owner. Disregarded entity, business activity reports on the owner's return. Very simple. There's not an additional tax return required. It's only an additional form on your 1040 tax return. And owner may own income tax plus self-employment tax. And we're going to get into those calculations later on this slide, so you can understand how tax is calculated on the single member LLC. So the S corporation is another form of pass-through entity. So the entity files its own tax return. So now in this case, you would be filing the tax return for your S corporation, and you would be filing the tax return for your individual as well. And we'll discuss how that income passes through is through Form K1. The 1120S or the S corporation tax return, once it's complete, it has a what's called Form K1, which is where it shows all the information that needs to be reported onto the individual 1040 return for those shareholders. And then that income is reported personally. Again, we'll get into those calculations on a later slide in this presentation. And then at the entity level, a C corporation files Form 1120. The corporation calculates corporate income tax owed. Owner taxation is completely separate. So you're going to file an 1120. No forms are going to bring income into your personal tax return from the C corporation unless it's a salary or a dividend, which for the purposes of this video, we're not going to get into, dividends and salary from a C corporation and double taxation. Just understand that, whenever we discuss C corporation, we're going to be, just have double taxation in mind because you're taxed twice. You're taxed when the corporate prepares its return and files it and pays tax owed on whatever the net income is and whatever money is distributed via the form of dividends. So who pays the federal income tax? So this is a little diagram that I created just to help people understand visually. When I have a single member LLC that has no election, so it's a disregarded entity, so revenue minus expenses equals net income. That is reported into the owner's 1040. And we're going to dig into the calculation later, exactly how this is calculated and what types of taxes we're paying when we report this activity onto our 1040. So owner is going to report that activity on 1040 by attaching Schedule C, and then the owner is actually going to pay the tax with their 1040. S corporation. Revenue minus expenses equals net income. So now the S corporation is going to report its own net income, and then it's going to issue a K1 to the shareholders that is going to show the allocations of that net income to each of the shareholders. In the case that there's one, it's 100%. And then that K1, that K1's income that's going to be reported onto the shareholders' tax return, that shareholder is going to report and pay based off of the income tax calculation on their personal return. So the S corporation is really never going to make a payment as the S corporation to the IRS. It's always going to be the shareholder is going to be making the payments based off of their salaries and net income from the S corporation. If they have other businesses, etc., that is how they're going to calculate their tax payments. The S corporation will never make a tax payment for itself. So the C corporation will make tax payments for itself. It's going to file its own form that has nothing to do with the owner's personal tax return. And this is kind of like its own entity, its own existing entity for taxation purposes. So the corporation will pay its own tax and it's completely separate from the owner. The same business profit can reach a different taxpayer depending on the federal classification. So in this case, the same business profit, if we'll get into a slide that details this a little bit more, but if we were to take 100K net income and apply it to each individual case, you can see like an individual will be responsible for the tax at the single member LLC, and the shareholder will be responsible for the tax on the net income of the S corporation based on their personal tax return information, and then the C corporation will be responsible for its own tax on net income generated. So single member LLC, there's two federal layers when we're looking at tax from a single member LLC. Once we generate net business income, we're going to have federal income tax. This is what we all pay from the money that we earn. That's reported on a 1040. Self-employment tax, generally 15.3%, applied to 92.35% of the net earnings subject to wage base and other rules. So self-employment tax essentially are the federal taxes, the Social Security, Medicare that you're going to find on your W-2 check if you're an employee. You're going to see those broken out. When you're a single member LLC, you do not get to escape those taxes. Nobody does. If you're an S corporation, part of the benefit of being able to have an S corporation is that the IRS expects you to pay yourself a reasonable salary, which again, on that reasonable salary, you're going to pay those FICA taxes, right? So you're never going to have a structure that's going to completely eliminate FICA taxes. You will have structures that will minimize it, and the structure should be coherent with your total tax strategy and your businesses. And there's a whole other layer of asset protection, etc., that should be discussed with an asset protection attorney. But there are tax efficient ways to structure your business to reduce FICA tax. Federal income tax, you're always going to owe federal income tax if you're making money. If your business is making money and you're living, chances are you're paying federal income tax either through the salary that you're paying yourself or through the business's net income, or a combination of both. I get really frustrated when I see people just like sending TikTok freaking videos or Instagram videos on people talking about how they eliminated their federal income tax and this is what you need to do to not pay income tax. If you're not paying income tax, you're not making money. And that does not mean to not be efficient. There needs to be a tax plan and strategy that has to be done before the tax year is over and throughout the tax year, which is the importance of retaining an accountant and a good accountant, right? That's going to work with you for planning. So we can strategically allocate funds to make investments of economic value. And if you're going to be one of my clients or you are my clients, don't send me the Instagram video of Grant Cardone buying a jet, telling people how they're going to save tens of millions of dollars on their tax return or pay none. A jet, if you're a contractor, most of the time is not going to have an economic value for your business. I'd rather you purchase a freaking skid steer so you no longer have to rent it, other than a jet that's going to cost you $10,000 of fuel an hour. So, there's my rent. You guys can send me the bill for psychology later. So these are the two types of tax that you should be familiar with that we're never going to evade. And in the single member LLC, it's referred to as self-employment tax, and we're going to see how that calculation happens later in this slide. All right, so S corporation, owner's salary. In your owner's salary is where you're going to be paying that FICA that we were discussing earlier. You're going to pay yourself a salary. You're going to pay federal withholding, which is essentially an estimated payment. If you've ever received a W-2 before, open your pay stubs and you can see that you're paying federal withholding, which is an estimated tax payment, and then you're paying Social Security and Medicare, which is your FICA. That's unavoidable. And then the remaining profit of the S corporation. Now, this is the important concept. So gross revenue minus expenses equals net income. Your owner's salary is actually in those expenses. So you're deducting your salary in your S corporation's books. So now that remaining net income is going to be considered just at the income tax level. We will not pay self-employment tax. So that's a very important concept, right? And this is where typically the S corporation structure is preferred over an LLC at a certain income level, right? There is a certain cost associated to running payroll. There is a certain cost and obligation from the IRS of your standards for maintenance of your books and records, right? So your accounting and administrative costs will go up. So there's a certain point of net income where clients should be an S corporation, right? Doesn't mean that go ahead, open an LLC and get S corp status just because you're gonna save money on your FICA taxes. No, you need to evaluate the level of net income. And currently at the firm's standards, depends on the industry, we will advise clients at what net income we advise for them to have an S corp or an LLC with an S corp election for their structure to be the most tax efficient. So owner salary is going to go into your owner's form 1040, right? You're going to report that as wages, so that's subject to income tax. And then your S corporation is going to issue a K1 that's going to be reported on your 1040, and that's going to be subject to income tax. So the employment tax benefit comes with a reasonable compensation and payroll requirement. So I want to talk a little bit about the reasonable compensation, and there's a lot of confusion even to accountants. if you look at tax court cases related to reasonable compensation, now a lot of it has to do with what your actual function in the company is, and um, the reasonable compensation for people doing what you're doing, and also your industry is very important too, right? So if I'm an attorney and I run a law firm that makes $1 million a year, and I'm the only guy that is running that firm, my gross margin is going to be very high, right? You're a professional services business. You don't have a lot of expenses other than the value of your time. So let's say your net margin is going to be 50%. So you're making $500,000 and you're paying yourself a $76,000 payroll because you saw there was a posting on Indeed of $76,000 and you went with that salary. Now, the position at the firm for that type of service is we would generally not recommend to use the Indeed post as your point of reference. There is some tax court cases that give guidance showing that the IRS would have expected an attorney that's generating $1 million of gross revenue with a 50% margin, and you're the CEO of your company. You should not be paying yourself the salary of an entry-level attorney. So, I mean, everyone's case will be different. This is just a very general guideline. If you have any questions, you should refer to your accountant or your tax attorney, or, you can retain the firm for tax planning, and we give you what we would suggest as our target. Like I said, the IRS does not really give any guidelines of a specific metric. They just say reasonable compensation, right? And the best thing we have to determine what reasonable compensation is to look at the precedent set of tax court cases to determine what's going to work best for your situation. All right, where does the S corporation tax benefit come from? So your single member LLC has your business net income, goes straight into your income tax via Schedule C. You're going to be subject to self-employment tax of about approximately 92%. We'll get into that calculation later. Generally, the net earnings from the business are the starting point for self-employment tax. So the S corporation is going to pay that same 15.3% in your salary. It's called FICA. You're only going to pay that FICA for whatever it is, or whatever portion the owner's salary is, and then the remaining K1 profit is not subject to that FICA, and that's only subject to federal income tax. So employment taxes applied to salary, remaining pass-through profit is generally not subject to self-employment tax, right? The S corporation does not eliminate income tax. The potential benefit is primarily an employment tax difference. So here's a calculation of an example of a single member LLC that had a business net income of 100 grand. So the calculation is 92.35% of that 100 grand is subject to self-employment tax. Self-employment tax off of that amount is $14,129.55. Yes, this is one of the taxes that you will pay on 100 grand net income of an LLC. This is this tax. You still owe this tax, and this tax will be calculated off of this number. And this part, just like any employee, an employee does not get to deduct their FICA on their 1040. Only the employer deducts his half, right, from your total FICA tax, your Social Security and Medicare. Half of it is paid by the employer, which is deductible. Half of it is paid by the employee, which is not deductible. As self-employed, you get the same benefit as everyone else. You're only going to deduct half of it, and off of your net income. And now we have our income that's going to be exposed to income tax, right? And that calculation is specific to everyone's case, depending on their W-2s and their other investments, etc., right? Let's go to the example for the S corporation. Same case. We have 100 grand, right? This is just an example. Everyone's case will be different. And the owner's W-2 salary is 30 grand. So now that 30 grand, the employer is going to deduct $22.95. Who's the employer? Your own S corporation. So 100 grand minus the salary, right? Because we know the owner's salary is also a deductible expense. Half of the FICA is also a deductible expense, meaning that my S corporation ordinary income, right, is going to be 67,705. That's what's going to flow through my personal tax return as income from my K1. Then my W2 and my K1 income subject to income tax is 97,705. So in this case, we see that my total FICA was 4590. In the single member LLC, you saw it was 14,000. And you see that 67,705 is subject to income tax plus 30,000. So in this case, we have a little bit more subject to income tax than we did at the single member LLC level. So, or whatever that difference between this number and the single member LLC number times your effective tax rate is going to be what your actual savings are at the income tax level, which you'll save on the LLC. However, we're saving 10 grand on FICA in this example, right? So this is where you start to see the benefit of the S corporation, because typically your owner's salary is not going to be in excess of your net income, right? It's not going to necessarily be this percentage, right? There's a lot of factors that will play into this. However, this is a very simple calculation on how you can see the difference of the FICA taxes and income tax impact onto your personal tax return, right? So you have the same $100,000 starting point, the different employment tax treatment. Now, I want everyone to kind of put a mental note. I mean, there's a few other taxes, the federal unemployment, state unemployment, that are kind of immaterial. You have other deductions that are available to certain cases for as the qualified business income deduction, and there's other factors that are going to show more or less benefit depending on your case. So this is the importance of consulting your business structure with your accountant, or you can retain the firm if you guys have any questions. There's a little extra things that I would like everyone to know exist, right? So this presentation is in no way telling you what you should or shouldn't do. This is just explaining what you need to know so you can sit down with your accountant and make the right decision moving forward. So let's go on to the next slide. So here you have single member LLC with the self-employment tax that is being reported onto the 1040. Again, different from income tax. Then you have, this is the S corporation self-employment tax that's being paid by the employee. So your potential difference in this scenario is this amount. Now, what I mentioned earlier, that there is administrative cost, right? This savings difference when you're doing your calculation should be in excess of the administrative cost that you are going to incur to have an S corporation versus a single member LLC. That is a very important number. If I'm saving 9 grand, but I'm spending 30 grand to have payroll and maintaining records and an accountant, etc., so I can comply with the requirements to have an S corporation, to have that benefit as per the IRC. It doesn't make sense. My cash flow is less. Now, if this number is in excess to those administrative costs, then we are saving money. And another important thing I like to tell clients, let's say you're a single member LLC and it's going to cost you exactly the same or a little bit more for the administrative costs and to retain an accountant to make sure your S corporation books are there. What is the value of having a good accountant on your team? A good accountant will pay himself off in the first 5 minutes of talking to you. A bad accountant, you're going to bleed money. So a good accountant will cost money, but a good accountant is also a strategic advisor for your taxes. And here at the firm, specifically for construction, we also do a lot of business consulting for contractors and tradesmen. So that's an additional benefit of retaining the firm. But if you're looking for the cheapest tax return, that's not going to be us, right? We want our clients to grow financially. I do not make money by having clients that do not grow. That's just the position that we have here at the firm. So you also need to look at, if you have a business with substantial activity and it's a single member LLC and it's growing, and your overall savings may not be that much by switching to S Corp, you're going to have a more administrative burden, but you get to have me on your team. That is a Huge strategic advantage that if you just kept trying to do everything by yourself without a strategic advisor. That's something that I also want clients to be conscious of moving forward, right? Is the administrative burden that is required when you have an S corporation over a single member LLC. So the S corporation misconception: profit does not equal distribution. This is like trying to explain, like, to most business owners something in an alien language. I don't know why people have such a hard time trying to figure this one out. So let's see if we can figure it out. If you have a question, please contact me. My contact's at the end of the slide, and I would be happy to discuss it with you, and we can, get on a call, right? So the S corporation earns income. This Schedule K1 reports the shareholders pass through income. Shareholder can owe income tax even when cash remains inside the company. Your S corporation made $1 million. Not a dollar hit your account. You still owe tax on that money. That is the way that the S corporation taxation works, right? Cash distribution. Company transfers cash to shareholder. Distribution reduces cash and generally affects the shareholder's basis. Non-dividend distributions are generally tax-free only to the extent of stock basis. What the hell does that mean? So now, if I'm looking at the net income of the S corporation, right? We made $1 million. I have $1 million in the bank now in my S corporation. I need to pay $400,000 of tax. Not that that's going to be the case if you have $1 million, but let's just throw numbers out there. My basis as the owner of that S corporation is now $1 million more than it was last year. So if I distributed $400,000 to pay the tax, am I paying tax on the distribution? No, because I already paid tax on those $1 million, which has now increased my basis. I took money from the S corporation, I distributed it to myself, and I paid my tax bill with it. I am not going to pay tax again on those $400,000. You are never going to reinvest money into a business that's not post-tax. The Internal Revenue Code is not designed that way. Now, there is ways to have tax advantage strategies to invest money, or the business to invest money. There's a lot of avenues in real estate investing, specifically in this case, talking about the S corporation. If I'm buying additional equipment and the way that that's depreciated and expensed, there's a whole bunch of things we can talk about tax plan and tax efficiency when you're trying to reduce your taxable income, as long as it has economic value for your business. I'm not going to get into any of those specifics in this video. I will likely release videos on certain tax advantage strategies in the future. However, for the purpose of this video and understanding profit and distributions as two separate concepts, right? I want everyone to think of the net income of the S corporation subject to tax. Does not have to do anything with my distributions. That net income increases my shareholders' basis. And year over year, hopefully if I'm making money every year, that shareholders' basis is going to grow. As long as my distributions are not in excess of that shareholders' basis, I will not pay tax on that money because I've already paid it, right? So this is a concept I see a lot of people struggle with. They struggle with understanding that, they left all the money in the business and they still don't understand why they're paying tax on income that was generated by their S corporation, right? Income creates tax. A distribution is simply a movement of cash. They are not the same event. Important distinguishing factor there. So very briefly, these slides are not about trying to dig into the C corporation, but just quickly to identify the difference of how different things are taxed and why you're going to hear so many people say LLC and S corporation election and drive you bananas. Using the same example as the S corporation, income before the salary, then you have the owner's salary, the employer's portion of the owner's salary that's deductible, and then you're going to have corporate income tax. This is going to be your corporate taxable income subject to corporate income tax, right? At the corporate tax at 21%, your corporation is going to pay this amount in tax, meaning that after tax corporate earnings are this amount. So looking at or thinking about the last slide about profit and or distributions from an S corp not creating a taxable event as long as it's not as in excess of your basis. Since a C corporation is a completely different entity for taxation purposes, if you distribute from your C corporation to yourself, that is a dividend. You are going to pay tax on it. So if your corporation paid income tax on its taxable income, those $67,000 went to the corporation's bank account, and you moved 15 grand to your personal account, and it wasn't salaries, it is a taxable dividend, right? And if you took it out for salaries, guess what? It's now salaries that's taxable on your 1040. So that's where the concept of double taxation comes from. Your corporation pays tax on net income, and it pays tax whenever that money goes to you, either salaries or dividends. So that's just a general explanation of how taxation works in C Corp. And for most of the population, C Corp structures won't generally not be beneficial for you. If you think they will be, or you just want to analyze at what point, or if it's beneficial to you right now, you should talk to your accountant, or retain us at the firm, and we'd be more than happy to answer your questions and to see if a C corporation was beneficial for you. So tax liability is not the same as tax due. So now that we're talking about owing taxes, right? If you're making money, you're owing tax at some point. Your tax liability is not the same as tax due. And this is an important concept to understand as an S corporation. So as we talked about before, an S corporation's net income flows through the personal tax return via K1. So that's going to be the amount subject to income tax. My salaries have federal withholding in it. So in my federal withholding, I'm essentially paying estimated tax at that point already, right? As I mentioned earlier. So look at your stub. You're going to see federal withholding, Social Security, Medicare. And the federal withholding is the part that we're paying estimated tax for federal income tax due at the end of the tax year, right? So estimated tax is not an additional tax. It is a payment towards the tax you already expect to owe. And very importantly, it's a payment towards the income tax you already expect to owe, right? If you're paying self-employment tax from an LLC, you're going to owe that onto your 1040. And as an S corporation, I'm always thinking of it as the federal withholding is a payment towards the income tax that I'm going to owe on my wages, and your quarterly payments should be covering the difference of the income tax that's going to be owed on the expected net income of the S corporation, right? So total tax liability minus payments and credits. Yes, your federal withholding is considered a payment, and so are your estimated payments, and any credits. If you have children, etc., and there's a lot of things to discuss for your personal tax level for you to discuss with your accountant or with us. So total tax liability minus payments and credits equals balance due or refund. If my total tax liability is in excess of my payments and credits, I owe money. If my payments and credits is in excess of my total tax liability, I'm getting a refund. Why do most people get a refund that are wage earners, right? It's because the United States has a pay-as-you-go system, right? Employers are required to retain federal withholding from salaries they pay employees. That's why everyone has to fill out a W-4 when you work for an employer, and then that employer uses that information to calculate what they're legally responsible to withhold on behalf of the government. That's going to be applied towards your total tax due on your tax return. The calculation, if it's done correctly, will always have more money on the IRS's side as an employee, right? That is the way the tax code is written. The IRS always wants more money on their side, period. So if I'm a business owner, am I exempt from that? No. This is why you need to make estimated payments when you owe money. And if you're a business owner and you have the correct W-4 from the salary that's being paid from that you're being paid by your S corporation, and you have net income in excess, most of the time you will owe additional tax. So federal income tax is a pay-as-you-go system, right? You have withholding, common for wages and payroll, and then you have estimated tax payments, common when pass-through, self-employment, or investment income lacks sufficient withholding. April is the reconciliation date, not necessarily the first date the government expects payment. So this is important to understand too. If I owed tax last year, that should already be a red flag for you. And you should be already talking to your accountant or talking to us before the tax year ends. Not it's too late. The sooner the better, because the IRS is expecting you to make quarterly payments, and if you don't, you're going to get calculated penalty and interest. And if you haven't made payments and you owed tax last year, you are already getting calculated penalty and interest. How does the IRS know? Well, when you make a payment, it's tied to your Social Security, and it's tied to your tax return. They will see when those payments came in, and they will start to calculate when they should have come in, and they are going to send you a letter of what you owe them. Or more commonly, you're going to see on tax returns, a lot of the times tax preparers do not disclose this, and they just kind of file returns, tell you what you owe, and most people just don't even look at the return and just make the payment. There are boxes that show what you're paying in penalty and interest, right? The tax software will calculate it for you already based off of the payment dates, etc., that you are plugging into the system, or if you didn't make any, it's going to calculate it, right? So if you've been paying tax, I guarantee you there's a very high percentage chance that if you go back to your tax return, you'll see that you've been paying penalty and interest in there and you haven't been making payments. We're paying the government now more than what they need to be paid because that's our responsibility. We're a pay-as-you-go system, not pay at the end of the tax year, or pay not even at the end of the tax year, pay when I file my tax return. So those payments are expected on a quarterly basis, and by April 15th, the full payment is due, regardless if I'm an extension or not. An extension is not an extension to pay, it's an extension to file. So if I need to extend because I need to prepare my return, and there's a lot of information that I'm still missing from other companies or other accountants, etc., I need to do an estimate of what that tax is going to be, and I need to make that payment by the tax deadline. If not, you're going to pay underpayment penalties and interest on the money that you needed to pay the IRS. That's going to be calculated the moment you file the return, and you tell the IRS what was owed. So this is a very important concept for business owners. If you're owing money, talk to your accountant, get your tax plan and your estimated tax payment strategy in order. All right, so do I need individual estimated tax payments? So standards at the firm, if you expect to owe at least $1,000 after withholding and refundable credits, or you see a client that does owe over $1,000 on their tax return, that already triggers this client needs to make estimated payments, right? So then, talking about safe harbor, before we dig into the slide, safe harbor is a penalty protection, not full payment. Typically, standards of the firm, when we find our clients that have tax due, they fall under this higher income rule. That's pretty much the average. So I kind of just apply that standard to everyone, and it's pretty safe. This 110% rule means that you paid 110% of your prior year payment due with your 1040. And if you're making more money, you're going to owe more tax, right? So that means if I made my payments through 4 quarters and we prepare the tax return to file by April 15th, and we discover that you made more tax payments, these payments are going to reduce that total tax amount. It's not like you lose that money. The April 15th filing is just a reconciliation. If you overpaid, they give you money back. Unfortunately, they don't pay you interest on that money. So we want to make sure that number is in compliance and as accurate as we can get it with the financial information that we have access to. Make sure we are also not, financing the government for free. So prior year percentage generally becomes 110% when prior year adjusted gross income exceeds 150,000 or 75,000 for filing separately. The firm, we typically just apply this standard to everybody, and it's worked for us, it's worked for our clients, and we haven't had any issues with it. So this is the safe harbor that we always recommend everyone. So meeting safe harbor may reduce the underpayment penalty and still leave a large balance due with the return. So that's a very, very important point. If I doubled my net income and I made 110% payments based off of the prior year's tax due, that does not mean that I'm not going to have a balance due by April 15th. When I prepare my return and I had double the net income, my balance due is probably going to be substantially higher. So as we're doing accounting throughout the year, we are keeping tabs on this, and we are making sure that the client is aware of the payment they will need to make before that time. And if they don't make it, they're going to get an underpayment penalty plus interest, right? So that's why it's important when you owe tax, red flag, route to accountant, productive conversation, plan, execute, move forward. So 2026 individual estimated tax deadlines. These are just important dates. Here at the firm, we take care of you. We let you know when to do. We send you an email when we're going to process the payment. We try to make it as much of a headache-free process for all our clients as possible, right? April 15th, not only do you owe your tax returns payment, you also owe the estimated tax for the current year. So again, if you're on extension, those estimates need to be done of where your tax return is going to be at. It's very, very important to stay on top of your accounting. If you've been doing your accounting at the end of the year, giving all your papers to accounting, and he's been prepping it, and you're owing payments at the end of the year, chances are, like I said earlier, you're paying the penalty and interest on your tax return, as well as you're not making your first quarter estimated payment, and you're going to get penalty and interest again. So super important concept. So you can budget cash flow correctly. That's why it's important. And the investment of an accountant is fundamental for businesses that are serious and are growing. If you just want to operate out of your truck for the rest of your life and not have any retirement or have any form of business that is a legacy, that's fine. You know, you can keep paying penalty and interest and not have an accountant for the rest of your life for all I care. Now, if you're trying to build a business that is a legacy, that is a large operation, that is a serious business, then you need to be working with an accountant that is on top of these things, right? And these dates are very important. So when I talk about estimated quarterly payments, you can see they're not exactly 3 months, right? The IRS gives you to April 15th in the beginning of the year because they allow the first quarter to close, give you 15 days. Then it goes to June 15th, a little bit of a shorter time. Tax season's over. You had enough time to do your calculations. Then you see September 15th. It's on the 15th day of that last month of the quarter. And then in the last year, they give you an extra 15 days, after that quarter close to go ahead and make your final estimate. And this is a very important, date for us. That Q4, a lot of the times, is going to go into very heavily tax planning. We take a look at net income if people need to invest in certain equipment they've been wanting to invest in that has economic value to help reduce, their taxable net income. And we start to have the calculations of what we expect the clients to owe by April 15th for all our premium clients. We have those calculations done pretty early in the year. It's a very important time period and a very important date. The two most important I would tell owners is January 15th and April 15th. Those are the two most important dates. But again, the firm will take care of your estimated payments. If you're engaged with us for an estimated payment engagement, if you owe tax, we'll always reach out to you and make sure that we communicate that and you're offered that engagement with us at the firm. So this is for basically just the internal standards of the company for any employees watching this. Explain what the client owes and why. I cannot tell the number of times clients have engaged the firm because they were upset that their prior accountants did not give them this information or disclose that they owed tax and penalty and interest. They kind of just filed their return every year with penalty interest and it didn't tell them everything, sent them a bill and rock and roll. So we need to build trust with the clients by getting ahead of this ball. So understand before acting, review classification, income, payroll, withholding, and prior year tax, right? This is kind of part of that end of the year portion, getting to that January 15th deadline, right? We need to make sure that everything is classified and closed and verified so we can understand the financial situation of the client fully before recommending a payment or recommending a certain tax plan, right? So these things need to be understood thoroughly. Trust but verify. Improve daily. Update projections as the business and owner circumstances change. This is the importance of communicating with clients frequently, and premium clients being like the larger businesses having a monthly engagement with us. It's that constant conversation is very, very important, and a lot of productive conversation. And normally the entire year's fee will be paid off of one conversation for those clients that are, growing businesses, that are hungrier clients, the people that want to build legacy, the people that are making the right moves and the proper planning, and their business structure works well as a result of the way that they look at their business, which is why they retain us as premium clients. Sure that daily we are on top of the services that we provide for the clients and understand their changes throughout the year. Communicate amounts, deadlines, and changes before the client is surprised. Right? Lead with follow through. I don't want any clients to be surprised at the firm. Right? We pride ourselves in providing a quality service that no other accountant provides. So deliver confidence. The client knows who pays, what is being paid, why, and when. Communicate to the client with confidence because we know the information. For anyone at the firm that does not understand anything of these slides, you should be routing questions to your responsible or to me directly, and we should be able to discuss this until you have a thorough understanding. Accounting is what we do, but our business is servicing clients, following up for work papers. Lead with follow through by communicating things ahead of time and expectations, being on top of things and their changes. Right? This is what we get paid to do. We don't get paid to do accounting. Anyone can get paid doing accounting, but not anyone can get paid our fees by delivering shitty service. So 5 questions every business owner should know. How is my business taxed? Who actually owes the income tax? What income tax is creating my tax liability? How much tax have I already paid? When does the rest need to be paid? All these questions are answered on these slides. And this is what I recommend all business owners should be able to answer themselves about their current situation. And if they don't, they should reach out to their accountant or to our firm and really be able to have a thorough understanding of how to answer these questions. If not, you cannot develop an effective tax strategy with someone if you do not understand the concepts. I cannot be a good shell contractor if I don't even know how concrete works, right? So you need to at least understand the basics. Leave the professional techniques and stuff like that to the firm, but be literate enough in tax and accounting to have productive conversations so we can get you a better advice and spend time on higher value conversations rather than very basic technical stuff. Tax compliance tells us what happened. Tax planning helps us decide what happens next, right? Our vision as a firm is not to provide clients with solely compliance. Compliance is a small portion of our business. The planning and the forecasting is where our firm is more competitive, or I would say the most competitive in construction accounting compared to any other firm. So tax compliance tells us what happened. Tax planning helps us decide what happens next. All right, so thank you for watching this video, and there's my contact information in case anyone wants to reach out and has any questions, and I would be more than happy to answer them. Have a good day.